Consumer goods giant Unilever says that its Nigerian unit saw profits soar 65% in the first quarter of this year on the back of increased sales in its food, personal care and other products divisions. Total revenue for the quarter was almost $30 million. That's up 45% from the same period in the previous year. Profit came in at $6.7 million, with food products accounting for the largest share, followed by its personal care and beauty and well-being segments. The company said its operations did face some headwinds, such as FX volatility, worsening power supply, and supply chain disruptions. In mining and metals giant Sibanye-Stillwater has warned that it might close unprofitable shafts this year if platinum group metal prices do not pick up. The miner has already let go of about 2,600 workers at its PGM operations in South Africa. Of course, the PGM sector, which was the biggest employer in South Africa's mining industry last year, has shed about 10,000 jobs as mining houses recalibrated their operations in response to plunging prices. Sibanye-Stillwater also expects overall PGM production from the country to dip slightly this year. It says that rising costs and a low basket price means that the mines at the top of the cost curve are loss-making. British oil giant BP posted slightly weaker than expected first quarter net profit, and that's following a recent strategic reset and also a slump in crude prices. The struggling oil and gas major posted net profit of $1.38 billion in the first quarter, which missed analysts' expectations of about $1.6 billion. Now, the results come as the energy major faces fresh pressure from activist investors less than 2 months after announcing a strategic reset. Of course, it had pledged to slash renewable spending and boost annual expenditure on its core business of oil and gas. BP's underperformance relative to industry peers such as ExxonMobil, Chevron and Shell has now thrust the energy major into the spotlight as a prime takeover candidate. Its shares fell 2.8% on the news. And finally, audio streaming and media platform Spotify saw its shares tumble more than 8% in pre-market trading in New York. That's after the streaming company reported operating profit that missed estimates. Operating income of almost $580 million came in below Spotify's forecast for $623 million. Spotify said the figure was weighed down by more than $86 million in social charges. The profit miss overshadowed a stronger gain in subscribers in the first 3 months of the year. The company reported a 12% increase in subscribers to 268 million, a sign that the streaming service strategy of expanding beyond music into audiobooks and podcasts is now luring more fans even as it raises prices. And that's a look at our corporate highlights this Tuesday.